anywhere with you, 'cause you fill my mind, oh, you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Till we fall asleep. The night is young, won't you sing for me? Won't you sing for me? Till we fall asleep.
Hello, everybody. Welcome to VC Masters, only on the Pod TV network. I'm Nick Pellavita. I'll be your moderator for today's show. In today's show, we're going to discuss startups. We're going to discuss SpaceX and what's going on in the venture capital market. And we're going to bring in none other than the star of the show, Dr. Salman Azar, who's a professor at Duke University and also heads up the Azimuth Opportunity Fund. So, Dr. Azar, they're going to be looking to you to answer some questions, especially SpaceX. We've all followed it. It went straight up, right? And then where did
like a rocket? Yeah, it went straight up. And, it is hard being me because I have friends who are amateur investors who think that they know better than professional investors, and they don't listen. And I told them not to get into this, especially with the 6-month lockup period. I told them, those who could sell, I told them to sell. One of them actually did listen, and he thanked me. The rest, I guess it's not bad because I can always tell them I told you so, or at least I can tell them in my mind. I never tell them. So SpaceX is down to about half of it what used to be, and part of the news that is driving that is that it announced its earnings, and actually people who were smart enough knew that the earnings were coming going to be sometime in August. But what a number of people didn't know is that at the earnings time, some of the insiders are allowed to sell their shares. And this is highly, highly unusual because usually there is a 6-month lockout period where people cannot sell their shares. But what SpaceX did was, very smart. Financial engineering is what we call it because it's not fraud since you're disclosing it. Usually when a company goes public, they have 6 months period where nobody can sell. But SpaceX was able to list their IPO so that they can sell about 7% at the first earnings announcement. And they can actually, if the earnings announcement is something better than a certain thing, then they can even sell more, and so on and so forth. So when 6 months approach in December, at that time, there's a lot more that has been sold already that for normal companies would be sold at that time. So that's what's driving this. People are beginning to find out about this. More people would find out. I think there is going to be a little bit of a bottom to this, and I think it's so hard to predict because this is a very uncharted territory. No company, no major company that I know of has done something like this before. SpaceX market cap now is 1.53 trillion, which is half of some of the big techs. I still think that's a little bit high, but there are analysts who think that there is an upside to it, and the target is some are targeting it to be much higher. But that's the news on SpaceX. What else do you want to talk about?
What's going on in the VC market in general? In other words, is there any new activity that's taking place right now?
There are a number of companies, major companies that are planning to list. OpenAI has recruited some financial sector board members, which seems like a signal that they are getting closer to listing. But it's really, if I were to characterize it, it's like a feast or famine, or, a term that I learned during COVID times is that it's a K-shaped recovery. And what a K-shaped recovery means is like the recovery is like this, that the companies that are really, really huge, like $1 trillion market cap is, by the way, the valuation of the company, that are valued at about $1 trillion. They are really, really kind of, insulated to a number of market volatility things because they just are so huge in themselves. So SpaceX, for example, is one of those companies. OpenAI is another company. Anthropic is rumored to have listed soon. The smaller companies, the companies where we play, which are usually a few billion dollars. And by the way, a few billion dollars used to be huge at one time before these humongous companies came along. Those companies that are a few billion dollars are still a little bit hesitant to get into the market, because if they, let's say, list for an IPO on a day like today, where the market is kind of like 1% down, or even worse, like a day, the days after the Iran war started, they are going to start with a negative momentum. And what happens with negative momentum is that things go down. In the pre-IPO or the private markets, that is known as a down round. And if you have a down round, what that means is that the valuation that you raised money now is lower than what your valuation was when you raised your previous money. And in the private markets, that time is like, at least a year, sometimes several years. So you don't really detect that down round phenomena until years to come. Whereas the public markets changed every microsecond. I don't know how fast they can change, but like they are a fraction of a second that they can change. And if it's something starts with a negative momentum, it can go down fast and furious. And if it does, and you, let's say, list at $50 and you close that day at $35, the next day you're probably going to be lower. And by the time the week is done, you're going to be at like $20 a share, which is less than half of what its value is. And that's going to generate such a negative sentiment in the market that it's going to be very hard for you to recover from that sentiment. So that's the reason why a lot of companies that are valued at a few billion dollars are hesitant. So I'm working with one company which was ready to list this quarter, and they have a few new kind of innovations coming into the market. And what they are hearing from investment bankers is that they are just going to wait until next year, where their revenues are going to be almost double, and that they are going to be much more profitable at that time, so they can go public at a higher level. And also the expectation is that the market would be a little bit more stable. Honestly, I've been waiting for market to stabilize for more than a year now. So it started with April, the tariff announcement. So I don't know if that strategy works. I don't know if it works to just bite the bullet whenever. Market timing is a psychological thing, in my opinion. It's not a quantitative thing. And tomorrow the Iran war may be over and the market may get a boost, and you may go IPO like at that time, and you get a positive momentum, which is like great. And you go public at 50, you close the day at 60, and by the time in a month you're at 100. And yeah.
Well, also the thing is there's timing the market or time in the market. And some of our commentators say time in the market is more important than timing the market. In other words, how long you're actually going to be in the market. But let's talk about some of these companies that are going public, especially the ones that are smaller. They're not the Anthropic. They're not the OpenAI. Are they engaged in what they used to have called road shows, where they went from city to city to talk about their product, usually to investor groups? Are you seeing road shows existing, or are we looking at social media taking over the roadshow? Part of the reason these other companies, let's just pick on SpaceX, were able to come out with such a big bang. They had Elon Musk, who was basically his own roadshow. Are these other companies engaged in roadshows, or have you seen roadshows be popular today as it was years ago?
So it is definitely not as possible, but what is that? Popular, but it is still happens. And there are some companies that specialize actually in helping companies do the roadshow, if I could say, virtually, so through social media and so on and so forth. But a number of companies really do a combination of that, and it's really not either or kind of situation anymore. It's really kind of what is the mix of that. So, you can almost think of it as that for me, my investing is a mix of like pre-IPO companies that are ready to go public this year or maybe next year. And then there are some companies that have more like 3 to 4 year lifetime, kind of runway. I do not want to have all companies that are going to go public in the same year because of all kinds of reasons, including tax issues and so on. And then also, I want to not have a whole bunch of money and I don't know where to park. So it's always better to kind of like, even the flow a little bit. So similarly for these companies, there is a huge incentive or huge kind of interest in combining it, the social media and the actual physical roadshow. So physical roadshows are not dead, but they are being used in combination with social media bits, and sometimes they feed off each other, right? So you will have a social media blitz on a roadshow, and you will try to, put butts in chairs, as they say, in the roadshow itself. And sometimes you would have the roadshow virtually on a Zoom call or, whatever your favorite web conferencing technology is. And there, by the way, there are companies that just specialize in help, just like, Goldman Sachs and JP Morgan specialize in like, investment bankers that specialize in taking you public. There are companies that specialize in doing the physical roadshows, and social media roadshows and all kinds of stuff.
Yeah, well, because that whole phenomenon is relatively new, do you see that these companies, are they more inclined, do they want to get listed on the New York Stock Exchange right away, or are they moving to the NASDAQ? In other words, it seems to me that we see a lot of the new companies when they go public, because the New York Stock Exchange rules are so hard to get listed there. Are you seeing a lot of them looking to say, okay, we're just going to NASDAQ? Or do you even see them looking at foreign exchanges? In other words, rather than be listed in the US, that they list their shares overseas to start with. What are your thoughts on that?
So in exactly the order that you mentioned, New York Stock Exchange is, or NYSE, as you may have known it, is really the first choice for most companies. NASDAQ is a very close second choice. Foreign listings are a rare third choice. Companies that pick foreign exchanges are typically the ones that feel that they can't get through the diligence process of New York Stock Exchange or NASDAQ. In fact, it's quite the opposite. There are foreign companies that try to go public in US, and they would usually pick NASDAQ because it's a little bit easier for them. The filing of the forms is slightly different. So S1 is the form, the well-known form that every company has to go through. And by the way, it's not a form; it's like a encyclopedia, I should say. If you ever have insomnia or trouble falling asleep, all you need to do is pick up an S1 and start reading it, and it will put you to sleep very quickly. But all that said, foreign companies can file an F1, which is the equivalent of S1, to go public in US, and that's more common than the other way around, that US companies are looking to go public elsewhere. Sometimes companies, especially big companies that go public in US, would have another listing in other countries, and it's very common for companies to list in US and then list in Canada or some exchange in Europe, and vice versa. So there are lots of companies in Hong Kong or foreign exchanges that would list in US as an ADR, American Depository Receipt or something like that it's called, which is kind of like a derivative trading. So for example, if you want to buy shares in Alibaba, which is listed in Hong Kong Exchange, I believe, you can do that in US Stock Exchange, and it would be through what is called an ADR.
Yeah, I traded Alibaba many years ago, but then I didn't have the stomach to stick with them.
It was going like phew, like at one time, and then like it went phew this way. And it has been kind of like this for lately.
Right. Now the thing is, latest thing is that all the movement is toward AI. Are you seeing some other shares of other stocks making headway against this AI craze? In other words, everything's crazy about artificial intelligence, but I see there's some opportunities in other areas. In other words, the niche opportunities. Are you seeing niche opportunities outside of AI?
Well, first of all, let me give you a statistic. This show started about 15 minutes ago, and it's about $40 million that has been spent in on AI since the show started. $40 million. So it's like almost like spending $3 million a minute or $2.5 million a minute. So AI is a kind of a two-edged sword. You can't live with it. We can't live without it. It is using, it's an accelerant for many companies. And almost any company that wants to grow or get funding these days needs to have an AI strategy to enable AI to be, to make the company more efficient. There are some companies that are AI only companies. So for example, OpenAI is a core AI company. Their entire profits are from like AI innovations. They do, they leave it to you to apply AI. Those kinds of companies are falling a little bit out of favor because the investors now want a return on investment, and they want the companies to have a path to profitability, and they don't quite see it in the AI-only companies like OpenAI. And by the way, you can see that signal in public markets because just Google announced their earnings yesterday. Record revenue, record profits, record this, record that, but their stock was hammered because of AI spending. So the same thing is going on in the private markets. It's just not as public information yet. Is that it's harder for these companies now to raise money at the valuations that they want to raise money, which means that their liquidity is in the public markets and selling their shares. So what this all summarizes to is that AI is a necessity to get funding and get investors on your side, but investors are getting a little bit smarter. And if like even people like me know about this, there are all these tracking tools and stuff like that are telling you and are signaling to you that we are not quite in the honeymoon period with AI anymore. Now, people feel that we are married to it, and just like when you're married, you will have fights, but you will also have good times, and that's exactly where AI is right now.
You talk about something that's very important is valuations. How do you value a company? When you take a look at a company, you look at it just pure financials, or are there some other things that you look at when you look at valuing a company?
Well, if you're listening in, I would ask you, how do you value your partner or your spouse or your fiance? It's kind of like that for private companies. For public companies, you basically just take what their stock price is, multiply it by the number of shares they have, and that gives you a value. So for example, if you have $100 a share and you have a million shares, the company's value is 100 million. When it comes to private companies, it becomes harder because there is no market out there that would give you the exact value. So it becomes more of a home appraisal kind of situation. So when you list your home, or when you are buying a home and you apply for a mortgage, they order an appraisal. And the appraisal process is that they compare you to other homes that were recently sold, and then figure out whether your home deserves a higher value or a lower value, and they adjust that in order to come up with an estimate of the value. So that's basically what happens in private companies, is that the companies that are already public have a well-known valuation, and you would go and see how you are doing against them. So for example, we have a company that we have invested in by the name of Questkey. It is similar to a few other companies like Klarna, Affirm, and so on. And the way we would kind of assess their value is to see what the revenues and profitability and growth, actually, I forgot the growth part, how these three metrics look compared to our company. And then we will adjust it up or down. And typically, when a company is private, the growth is faster, so it gets a boost from that. But also the scaling hasn't quite finished yet, so there's not that economy of scale that the bigger companies have, so they kind of get dinged for that, and they get dinged for a little bit of risk because they're not as diversified as the public companies would. So typically you would look at a public company X, you would give it a little bit of boost, your private company a little bit of boost because of the growth. You will ding it a little bit because of the risk, economy of scale, profitability, and things like that. And you'll come up with a range of values with certain confidence interval. I don't know if that kind of explains it in a nutshell. I mean, there's a lot more to it, but that's kind of like what the simpler explanation.
It's difficult to assign valuations. That is something that I definitely see problems with. Okay, what about private equity? In other words, some of the people I've discussed with saying, well, why would you go public when there's so much private equity in the marketplace today where companies aren't going public, they're just selling to private equity groups? Are you seeing this to be a trend, or is the IPO traditional registration statement, is this the trend for companies to go?
It is definitely a trend. And the challenge here really is that the companies that do not have a very clear path to a venture-backed exit, and by venture-backed exit, I mean either a merger or a public offering, they often would go to the private equity market. Oh, by the way, the merger, I mean merger or acquisition by a public company. So if they cannot get to the public thing, then private equity kind of like is a bailout. And the best analogy I have is what I learned when I was working on my PhD. When you're working on your PhD, you collect a master's on the way because it's like an insurance policy. And that insurance policy basically means that if you fail your PhD qualifying exam or you weren't able to finish your thesis, you get a master's, and they thank you and they put a gown on you, and nobody ever knows that you flunked out. So private equity exits for venture-backed companies are exactly that. And the reason they are that is because most good founders and good companies would hate that exit due to a simple fact that private equity wants controlling interest in your company. So you basically have a PE firm, private equity firm, that takes 51% of your ownership and sets metrics and takes the control away from the founder. Philosophically, that is completely opposite of what VC-backed companies do. Is that what we do is we take a minority interest, we are on equal footing with the founders, and we use that incentive to reduce our time commitment and diversify and incentivize the founder to go to the next level. So if the founder is not capable of going to the next level and VCs are no longer backing them up, there is a gap. And that gap is filled by the PE companies. I'm sorry for insulting the PE companies that are out there, but that's exactly what the thing is. So for example, a company that's worth $2 billion, it can go public by just floating a little bit of their shares and retaining half of the board control. When they go the private equity route, the private equity would invest a little bit more than $1 billion with them, get a 51% controlling interest, no minority kind of protections. Minority rights are, by the way, where the minority shareholders are protected by certain laws, so that the majority doesn't outrule them and everything. And that's kind of like for the lack of a better word, it's a bailout. And if a founder is tired, incapable, that's the route they would go to.
Yeah. Have you seen problems with founders getting older? Like there's a company in the Raleigh-Durham area called SAS Systems, as they were exploring going public, and then that's part of it is because the founders, Goodnight and Sal, are both in their 80s, and now they're not going to do anything. Are you seeing a problem as America ages and these founders get older that nothing happens? In other words, they just stay with the company. Is this also going to be a problem, especially with the companies where they have more senior founders that are out there?
Yeah, so in the neighborhood I live in, like there are about 10% of the people are SaaS employees and 10% are Duke employees. So I'm kind of familiar with what's going on there. There are a lot of changes coming. SaaS has been trying to go public for some time, and that's so SaaS used to be a very, very generous company at one time. For example, my primary care physician left to go to SaaS because they have a doctor on site that you can just go visit. Compare that to like Duke University employees where we can't, we have to wait for like months to get an appointment. Well, actually, maybe months is an exaggeration, but we have to wait for like weeks to get an appointment with our primary care physician. And they can basically have, somebody on site that you can get an appointment at any time. Those kinds of benefits are being scaled back now as the company has tried to go public. And it's kind of, unfortunately, it's running into like this really, kind of what is kind of a tweener syndrome where they should be a public company, but they aren't a public company because of all kinds of issues that I don't know most of those issues. They're not public yet. But as founders get older, private equity becomes a very viable exit option for them because they won't leave the company anyway. And if you're leaving the company, then you don't want any control. You want to just sit and, as they say, spend more time with your family. So I mean, I think for our older founders and people who are like burnt out, private equity is a great exit option.
So where do you see the VC market in the next 6 months? We have obviously some challenges in Iran. We have some challenges here in the United States with inflation and the national debt. Are we looking at the VC market to be expanding in the next 6 months, decreasing, or basically staying the same? Put on your magic hat and
so I'll have to do the magic hat because my time machine is not working these days. I'm trying to fix it. I would have loved to kind of go 6 months into the future and come back. So I'll tell you what I'm seeing now and what leads me to that conclusion. So what I'm seeing now is because of the delay of IPOs, we are getting deal flow coming out of our ears because there are a lot of funds that are in the late stages in the last year of their life, and they are desperate to sell so that they can return money to their investors. You can think of this as an analogy. As a person dying, and they have two options. One is that they will their property over to whoever is inheriting it, or they sell and give cash out or use cash themselves. And what typically these funds are doing is the same thing that most people that are near the end of their life is that they are selling some of their assets to use while they're still alive. And then the rest, they are basically saying, okay, fine, we'll leave it to take care of our family and all that stuff. So we are getting good deals from the buy side. Our challenge is that not many VCs are buying more, and there is the liquidity crunch is worse than it was about a year ago. So there are two kind of paths that I see, and 6 months is kind of like what bothers me. But ultimately, in a few years, this supply-demand thing would be taken care of like most other things. But until then, it is going to be a buyer's market. And that buyer's market would certainly last for the next 6 months, which means that if you are now, if you have cash now, it's a good time to buy. And if you have shares in a year, 1 to 3 years, it would be a good time to sell. So you can't really, taking advantage of the supply-demand mismatch, it's always better to, this is where market actually you can time yourself, right? Because it's like, during COVID times, there was a chip shortage and the car prices would come very high. It was a good time. If you had an extra car sitting in your driveway, sell it. And then, when the chip prices roll, then you can buy it. So it's a similar kind of thing, but it's very predictable. It's just that I can't predict whether it's definitely not 6 months. I can't predict whether it's 1 year or 3 years. It's sometime between that.
All right. But the thing is, the future looks good, and the buying opportunities are now. And also what's now is we're out of time. So we want to thank Dr. Salman Azar, the VC master himself, and our viewers in the United States and around the world. And we'll see you next time on VC Masters on the Pod TV network. Take care.
I go anywhere with you, 'cause you fill my mind, oh, you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me